Knowledge of wealth here. Sorry, I've been out for a while. I've been busy with work and personal development. I just wanted to go over a couple stocks here, the Axon and the SpaceX that uh, is IPOing here in, I think I saw June 12th, or it should be IPOing in June. So Axon had come up in just a search for kind of stocks that are associated with Donald Trump buying. Sometimes I'll look at stuff that Congress members or things like that bought. So it kind of popped up when I um, asked about like maybe the top 5 more recent stocks he's buying. And it kind of caught my eye because I have not heard of this one before, but I did buy just a little bit of this recently. So my view is high risk, but it could be high reward, and it kind of makes sense to also looking at the charts and stuff. It just seemed like a good time to buy. Axon, full rundown the business. Axon operates in 2 main segments: software and services. Cloud-based SaaS solutions, including Axon Evidence, Draft 1, Axon Records, Axon Assistant, and Axon Fusus, and connected devices. Tasers, body cameras, fixed and in-car cameras, drones, counter-drone tech, and VR training hardware. The company serves first responders across federal, state, local, and international governments, as well as commercial enterprises. Founded in 1993 and based in Scottsdale, Arizona, Axon serves clients, including law enforcement agencies and various government levels, corrections, fire, and EMS responders, and commercial sectors, such as healthcare and private security. Latest financials. Q1 revenue came in at $807 million versus $603 million a year earlier. Net income rose from $87 million to $169 million, and diluted EPS from continuing operations increased from $1.08 to $2.05. AI-related product revenue grew by more than 7 times year over year, driven by offerings such as Axon Vision, Axon Assistant, and Draft 1, contributing to a net revenue retention rate of 125%. The Dedrone counter-drone acquisition added momentum, with bookings up about 500% and revenue more than 300% year over year. Axon raised its full-year revenue growth guidance to a range of 30 to 32%. As of March 31st, Axon has $731 million in cash and short-term investments against $1.8 billion in outstanding senior notes, resulting in a net debt position of approximately $1 billion. Valuation: what the models say. Simply Wall Street pegs the analyst target consensus rate at $717, implying the stock is roughly 44% undervalued at the current $397 price. Their snowflake score gives future growth a perfect 6 out of 6, but valuation scores just 2 out of 6, and past performance 1 out of 6. Earnings are forecast to grow 47% per year. Analysts are in agreement the stock will rise significantly. They note a sharp divergence in their own models. The DCF models reaches a different conclusion with a fair value of 606, warning that even strong top line growth may not justify the current price when looking at long-term cash flow assumptions. Morningstar's quantitative model hits the fair value at 766. but flags a high uncertainty rating, noting the stock is at a 663% premium. The 5-star deep value buy price is listed at just 142, and the 1-star overvalued threshold is 953. Axon does not have a dedicated analyst covering it for Morningstar. This is quantitative algorithmic rating. 15 Wall Street analysts have given Axon a buy consensus rating with a price target of $728. Despite strong quarter one operational performance, the stock trades at a PE ratio of 252x. And the Investing Pros data suggests shares are currently overvalued relative to its fair value estimate. Bull case, the AI flywheel is working. The shift from hardware to AI-centered software and services platform is showing up in results. 7 times AI revenue growth, 125% net revenue retention, and 34% overall top-line growth for the 9 consecutive quarters above 30%. Enormous TAM expansion. Management has set ambitious targets of $6 billion in revenue and 28% EBITDA margins by the fiscal year of 2028. It's pushing into adjacent markets like healthcare, corrections, and counter-drone capabilities. Durable competitive moat. Axon's hardware integrated platform, regulatory compliance requirements, and flywheel model create strong barriers against AI commoditization. Customer switching costs are high once agencies are embedded in the Axon ecosystem. Contracted backlog. Axon reported $14.3 billion in contracted bookings, provided strong revenue visibility for years ahead. Stock has been beaten down. The stock is down 30% year to date and nearly 47% the past year, despite a strong quarter one beat and raised guidance, arguably creating a better entry point relative to where it traded 12 months ago. The bear case, extreme evaluation. We have a high P to E ratio. Margins have compressed. Profit margins 4.5% are below last year's 18.1%. Choppy earnings quality over the past 5 quarters. The DCF gap to fair value leaves little room for error, even with forecast revenue growth of around 20% annually and earning growth of 30% per year. Investors are still paying a steep premium. Execution risk on ambitious targets. The $6 billion revenue and 8% EBITDA margin targets by 2028 must now be backed by measurable revenue and margins gained from AI launches. This is within a 2 to 3 year window. Regulatory and pricing pressure. The bear narrative on SWS centers on rising regulation and pricing pressures potentially hindering future performance. The bottom line, Axon is a genuinely high-quality business in the middle of meaningful transformation from hardware manufacturer to AI-powered public safety platform, and the financial results back that up. The debate isn't really about whether the business is good. It's about the price. At $397 and a 252x P to E, the stock demands flawless execution on targets that are 2 to 3 years out. Bulls see a 44 to 80% upside on to analyst targets. Bears see DCF models suggesting dramatic overvaluation at current earnings level. This sits squarely in the high conviction, high risk territory. So I bought just a little. I think a couple days ago, and let's see. this morning as well. I bought a little more. So let's see. Axon. And you can see today it like really popped. So, yeah, I don't know. It almost might, it's close to popping almost too much to buy it now, but maybe just drip a little in. It's up to you here, but I think it's worth keeping an eye on it. If the president bought it, I don't know. It just seemed something to look into. It's an industrial and defense stock. But like I said, some of those targets by a lot of analysts have it above 700 and it's still only 439. Let's talk a little about the SpaceX. My philosophy is I'm going to buy a little when it IPOs and then wait 3 months and then look for buying dips. But I personally believe the Starlink could kind of take over all internet and phone companies. It could really be that huge, possibly. So I definitely want to have some skin in the game on that one. But yeah, let's see what we know so far with the SpaceX IPO. They have officially filed the S1 with SEC targeting a $2 trillion valuation, seeking to raise more than $75 billion, which would be the largest IPO in history. It plans to list under the ticker SBCX, duly listed on both NASDAQ and NASDAQ Texas. The financials. SpaceX achieved revenue of $18.6 billion in 2025, up from $14 billion the prior year, but suffered a net loss of $4.9 billion. And on a side note here, like humongous companies like Amazon and Tesla, they went years and years operating at a loss, so it's normal, and especially with the humongous things and the infrastructure that are building in space. So a net loss for a few years is not really a big deal. It's just part of the process. So in Q1 of 2026, revenue was $4.7 billion with a net loss of $4.3 billion. The business under the SpaceX umbrella, Starlink. The cash cow Starlink produced $11.4 billion of revenue in 2025 and $4.4 billion in operating income, growing to 10.3 million subscribers across more than 160 countries. One investor called it a cash machine. However, average revenue per subscriber has dropped from $99 a month to $66 a month in Q1 2026, a 33% decline, driven by cheaper international pricing tiers, and SpaceX explicitly forecasts this will keep falling. Number 2, the launch rocket business, Falcon 9 and the Starship. The 2025 launch set a new annual record at 165 Falcon 9 missions with 100% payload delivery success, of which 123 deployed Starlink satellites. Starship, still in development, is the centerpiece of the Mars and deep space ambitions, and if it works at scale, it could dramatically cut the cost of reaching orbit. Their third business, XAI, AI and Grok. SpaceX merged with XAI in February of 2026, In quarter one of 26 alone, SpaceX spent 7.7 billion in capex on XAI, 76% of total capex, while XAI showed a 2.47 billion operating loss in the same period. Orbital data centers, AI infrastructure, a newer speculative bet. SpaceX has recently announced partnership with Anthropic, paying $15 billion a year to use SpaceX data centers. The vision is to put compute infrastructure in orbit, though this is largely unproven technology. So yeah, basically they're going to put data centers in space, and I wouldn't put it past them to be able to do that myself. So what's the bull case? SpaceX has the strongest private launch franchise in the world, and Starlink has scaled into a major recurring revenue business. ARK Invest projects SpaceX could hit a 2.5 trillion enterprise value by 2030. The base case, Starlink alone, a typical broadband infrastructure multiples, could be worth 600 to 800 billion, and the space segment adds another 2 to 300 billion. If Starship delivers, cost to orbit collapse, and SpaceX captured massive upside across launch, satellite deployment, and orbital computing. Well, we got to look at the bear case. AI adds heavy losses, capital intensity, and governance complexity. If investors are paying a 1.75 trillion valuation, they are not only paying for the businesses that exist, they are paying for the belief that AI infrastructure will become an enormous profit pool and that SpaceX can win there. Key risk: losses are accelerating, largely due to, it looks like, investing in the XAI. Debt and IPO proceeds. A $20 billion bridge loan disclosed in the S1 could force SpaceX to use IPO proceeds for repayment, limiting how much of the $7 billion raise goes towards actual new growth. Governance and Musk conflicts. SpaceX has been buying hundreds of millions in Tesla products, Megapacks, and Cybertrucks as related party transactions. Public investors will scrutinize whether these are arm's length deals. Starlink ARPU erosion. The subscriber base is growing, but revenue per user keeps falling. Whether growth can permanently outrun that compression is an open question. Bottom line: Starlink is the proven business carrying the whole thing. The $600 to $700 billion premium above that is essentially a pure bet on XAI and orbital computing, both of which are burning cash aggressively today. The bull case is that public investors are finally getting access to the most important private company of the last 20 years. The bear case is that they're being asked to pay public market prices for private market mythology. All right, that's all I have today. All right, peace.